Welcome to our deep dive into the world of investing. Today, we're exploring one of the most important questions every investor faces. Should you focus on long-term or short-term investing? Both strategies have their unique advantages and challenges, and understanding the differences can help you make smarter financial decisions. Whether you're just starting out or looking to refine your approach, this video will break down the essentials, compare the two styles, and help you discover which path aligns best with your goals. Let's start by defining what we mean by long-term and short-term investing. Long-term investing is all about patience and vision. Investors who choose this path typically buy assets like stocks, bonds, or real estate and hold on to them for several years, sometimes even decades. The goal is to benefit from the power of compounding returns and ride out the market's ups and downs. This approach is often favored by those planning for retirement or major life milestones, as it allows investments to grow steadily over time. Let's look at how this strategy works and why it appeals to so many people. Short-term investing, on the other hand, is about seizing opportunities in the here and now. Investors in this category buy and sell assets within a much shorter time frame, sometimes days, weeks, or a few months. The aim is to capitalize on quick price movements and market trends. This strategy can be exciting and potentially lucrative, but it also comes with higher risk and requires more active management. Let's explore the key features of short-term investing and who it might be best suited for. Now that we've defined both strategies, let's compare their main differences. Long-term investing focuses on gradual growth and stability, while short-term investing is about rapid gains and quick decisions. The time horizon, risk tolerance, and required involvement are all distinct. Understanding these differences is crucial for choosing the right approach for your financial situation and personality. Next, we'll break down the pros and cons of each strategy to help you weigh your option. Long-term investing offers several compelling benefits. First, it allows your investments to grow through compounding, which can significantly increase your wealth over time. Second, it typically involves less stress as you aren't constantly monitoring the market. Third, long-term investors often pay lower taxes due to favorable capital gains rates. Finally, this approach can help you avoid emotional decisions based on short-term market fluctuation. Let's see why these advantages make long-term investing a popular choice. While long-term investing has its strengths, it's not without drawbacks. One major downside is the need for patience. Returns can take years to materialize. Additionally, your money is often tied up, making it less accessible in emergencies. There's also the risk of market downturns affecting your portfolio, especially if you need to cash out during a low point. Understanding these challenges is important before committing to a long-term strategy. Short-term investing can be attractive for those seeking quick returns. The main advantage is the potential to profit from rapid price movements, allowing you to take advantage of market trends. This strategy also offers greater liquidity as your money isn't locked up for long periods. Plus, it can be exciting and engaging for investors who enjoy active trading. Let's highlight why some people prefer this fast-paced approach. However, short-term investing comes with its own set of challenges. The biggest is the higher risk. Markets can be unpredictable and losses can happen quickly. This strategy also demands constant attention and quick decision-making, which can be stressful. Additionally, frequent trading may lead to higher taxes and transaction costs, eating into your profits. It's important to weigh these factors before diving into short-term investing. Long-term investing is often best suited for individuals with a stable income, clear financial goals, and a willingness to wait for their investments to grow. If you're saving for retirement, a child's education, or a major purchase years down the road, this strategy can provide the steady growth you need. It's also ideal for those who prefer a hands-off approach and want to minimize the emotional roller coaster of daily market swings. Short-term investing may be a better fit for those who thrive on action and have the time and expertise to monitor the markets closely. If you have specific financial goals in the near future, such as buying a car or funding a vacation, this approach can help you reach them faster. It's also suitable for investors who are comfortable taking on more risk and can handle the stress of frequent trading. A personal risk tolerance is a key factor in choosing between long-term and short-term investing. If you can handle market volatility and potential losses without panicking, you might be comfortable with short-term strategies. On the other hand, if you prefer a more stable, predictable path, long-term investing may be more your style. Assessing your comfort with risk is essential before making any investment decisions. Another important consideration is the amount of time you're willing to dedicate to managing your investments. Long-term investing generally requires less day-to-day involvement, making it suitable for busy individuals. Short-term investing, however, demands regular monitoring and quick responses to market changes. Think about your schedule and how much time you can realistically devote to your investment strategy. Your financial goals play a huge role in determining the right investment strategy. Are you aiming to build wealth for retirement, or do you need funds for a short-term expense? Long-term investing is ideal for goals that are years away, while short-term investing can help you meet immediate needs. Clarifying your objectives will guide you toward the most suitable approach. Short-term investing often requires a deeper understanding of market trends, technical analysis, and economic news. If you're new to investing or prefer a simpler approach, long-term strategies may be easier to manage. Consider your level of experience and willingness to learn before choosing a path. Investing can be an emotional journey, especially during market swings. Long-term investors benefit from staying calm and sticking to their plan, while short-term traders must make quick decisions without letting emotions take over. Developing emotional discipline is crucial for success in either strategy. Diversification is a key principle in both long-term and short-term investing. By spreading your investments across different assets, you can reduce risk and improve your chances of success. Long-term investors often diversify with a mix of stocks, bonds, and real estate, while short-term traders might focus on various sectors or asset classes. Let's see how diversification can protect your portfolio. Taxes can have a big impact on your investment returns. Long-term investments often qualify for lower capital gains tax rates, while short-term gains are usually taxed at higher rates. Frequent trading can also increase your tax bill. Understanding the tax implications of your strategy is essential for maximizing your profits. Every time you buy or sell an investment, you may incur transaction costs such as commissions or fees. Short-term investors who trade more frequently can see these costs add up quickly. Long-term investors with fewer trades generally pay less in fees over time. Keeping an eye on transaction costs is important for protecting your returns. Compounding is the process where your investment earnings generate their own earnings over time. This powerful effect is a major advantage of long-term investing. By reinvesting dividends and letting your returns grow, you can build wealth exponentially. Short-term strategies with frequent withdrawals may miss out on the full benefits of compounding. Market volatility refers to the frequent and sometimes dramatic price swings that can occur in financial markets. Short-term investors often try to profit from this volatility, but it can also lead to significant losses. Long-term investors, on the other hand, aim to ride out these fluctuations, trusting that markets will recover over time. Liquidity refers to how easily you can access your money. Short-term investments are generally more liquid, allowing you to cash out quickly if needed. Long-term investments may be less accessible as your money is tied up for years. Consider your need for liquidity when choosing an investment strategy. It's important to set realistic expectations for your investment returns. Long-term investing is unlikely to make you rich overnight, but it can steadily grow your wealth. Short-term investing may offer quick gains, but losses are also possible. Understanding what each strategy can and cannot deliver will help you avoid disappointment. A well-constructed investment portfolio balances risk and reward by including a mix of assets. Long-term investors might focus on stocks, bonds, and real estate, while short-term traders may include more liquid assets. Building a portfolio that matches your strategy and goals is key to long-term success. Regardless of your strategy, it's important to regularly review your investments. Long-term investors may check their portfolios a few times a year, while short-term traders need to monitor the markets daily. Staying informed helps you make timely adjustments and stay on track toward your goals. Losses are a natural part of investing. Long-term investors can often recover from downturns by staying the course, while short-term traders may need to cut losses quickly. Developing a plan for handling losses will help you stay calm and focused, no matter which strategy you choose. Research is essential for making informed investment decisions. Long-term investors might study company fundamentals and economic trends, while short-term traders often analyze charts and news. Dedicating time to research can improve your chances of success in any investment strategy. Both long-term and short-term investors can fall into common traps. These include chasing hot trends, ignoring fees, or letting emotions drive decisions. Being aware of these pitfalls can help you avoid costly mistakes and stay on the path to financial success. Markets and personal circumstances can change over time. It's important to stay flexible and adapt your investment strategy as needed. Long-term investors may adjust their portfolios as they approach retirement, while short-term traders might shift tactics based on market conditions. If you're unsure which strategy is right for you, consider consulting a financial advisor. Professionals can help you assess your goals, risk tolerance, and financial situation to create a personalized investment plan. Getting expert guidance can boost your confidence and improve your results. Let's look at a real-world example of long-term investing success. Imagine an investor who bought shares in a solid company and held them for 20 years. Despite market ups and downs, the value of their investment grew steadily thanks to compounding and reinvested dividends. This case highlights the power of patience and a long-term perspective. Now, consider a short-term investor who spots a market trend and acts quickly. By buying and selling at the right moments, they make a significant profit in just a few weeks. While this approach can be rewarding, it also requires skill, timing, and a willingness to accept higher risks. Some investors choose to blend long-term and short-term strategies. For example, they might hold a core portfolio for the long haul while allocating a smaller portion to short-term trades. This hybrid approach can offer the best of both worlds, balancing stability with the potential for quick gains. Regularly reviewing your investment progress is essential. Set milestones and check whether you're on track to meet your goals. If your strategy isn't delivering the results you want, don't hesitate to make adjustments. Staying proactive helps you stay aligned with your financial objectives. Every investor learns from experience. Whether you choose long-term or short-term investing, you'll gain valuable insights along the way. Reflecting on your successes and mistakes will help you grow as an investor and make better decisions in the future. The financial world is always changing. Staying informed about market trends, economic news, and new investment opportunities can help you make smarter choices. Make it a habit to read, watch, or listen to reliable financial sources regularly. FOMO, or the fear of missing out, can lead investors to make impulsive decisions. It's important to stick to your strategy and avoid chasing the latest trends or hot stocks. Staying disciplined will help you achieve better long-term results. Patience is a virtue in investing. Long-term investors in particular benefit from waiting out market downturns and allowing their investments to grow. Even short-term traders need patience to wait for the right opportunities. Remember, good things often take time. Technology has transformed investing, making it easier than ever to access markets and manage portfolios. Online platforms, apps, and tools can help both long-term and short-term investors track their progress and make informed decisions. Embracing technology can enhance your investment experience. Investing is a journey, not a sprint. Staying motivated through ups and downs is key to achieving your financial goals. Celebrate your progress, learn from setbacks, and keep your eyes on the bigger picture. Consistency and perseverance will pay off over time. Let's recap what we've learned. Long-term investing focuses on steady growth and patience, while short-term investing aims for quick gains and requires active management. Both strategies have their pros and cons, and the right choice depends on your goals, risk tolerance, and lifestyle. Choosing between long-term and short-term investing is a personal decision. Take time to reflect on your financial situation, goals, and preferences. Remember, there's no one-size-fits-all answer. What matters most is finding a strategy that works for you and sticking with it. There are plenty of resources available to help you learn more about investing. Books, online courses, and financial websites can deepen your understanding and boost your confidence. Investing in your education is one of the best steps you can take toward financial success. Successful investors build good habits over time. This includes regular saving, disciplined investing, and ongoing learning. By developing these habits, you'll be better prepared to handle the challenges and opportunities that come your way. Both long-term and short-term investing offer unique paths to financial growth. The key is to understand your own needs and choose a strategy that matches your goals and personality. Stay patient, stay informed, and remember that investing is a lifelong journey. Thank you for joining us on this exploration of long-term versus short-term investing. We hope you now have a clearer understanding of both strategies and feel more confident in making your own investment decisions. Remember, the best investment you can make is in yourself and your financial future.